Microsoft just signed a 20-year deal to restart a nuclear reactor at 3 Mile Island. The price tag, $16 billion. The site of America's worst nuclear accident reopened to power AI. Why? Nuclear is the only round-the-clock clean power that can feed a data center, and one company owns more of it than anyone in America. That company is Constellation Energy, a power utility, trading at 23 times earnings like a tech stock. Here's why the market stopped treating it like a boring utility. Start with the problem AI created. A single large AI data center can draw a gigawatt of power, as much as a major city. And it needs that power 24 hours a day, every day. Solar stops at night. Wind comes and goes. But an AI cluster never sleeps. That leaves exactly one source of clean, always-on, large-scale electricity. Nuclear. Suddenly, the most out-of-favor energy in America became the most strategic, and the company sitting on the most of it had been hiding in plain sight. Here's what Constellation actually owns. The largest nuclear fleet in the United States, about 22 gigawatts across roughly 21 reactors. It alone generates more than 10% of all the carbon-free electricity in America. You cannot build this. A new reactor takes a decade and tens of billions of dollars, if regulators even approve it. Constellation's reactors already exist, already run, and are already licensed. In an AI power crunch, that installed base is almost impossible to compete with. Then the hyperscalers came knocking, with 20-year checkbooks. The headline deal, Microsoft and the Crane Clean Energy Center. The restart of 3 Mile Island Unit 1, 835 megawatts, a 20-year power agreement, and a $1 billion federal loan guarantee behind it. Then Meta signed for the entire output of Constellation's Clinton plant. Also 20 years. These aren't spot sales. They're decades of contracted, inflation-protected cash flow from the richest companies on Earth. That's what turned a utility into a growth story. So is the business actually delivering? Yes. In 2025, Constellation did $25.5 billion in revenue, up 8%, and earned $9.39 in adjusted operating profit per share. And it has now beaten the midpoint of its own guidance 4 years in a row. Rare discipline for a power company. This isn't a speculative story stock. It's a cash-generating utility that happens to sit on the most strategic energy asset of the AI era. If you like the company behind the trend, subscribe. Next in this series, the drug maker rewriting what a trillion-dollar pharma looks like. Then, in January, Constellation went big. It closed its acquisition of Calpine for $16.4 billion, about $27 billion including debt. That deal made Constellation the largest private power producer in America, roughly 55 gigawatts of capacity. It bolts the country's biggest natural gas and geothermal fleet onto its carbon-free nuclear base. Translation, it can now sell clean baseload and the fast, flexible gas power that fills the gaps. Management says it adds about $2 billion a year in free cash flow. Now the number that explains the tech stock multiple. For 2026, Constellation guided to $11 to $12 in adjusted earnings per share, and it's targeting more than 20% annual earnings growth all the way through 2029. 20% growth from a utility. That's a software company trajectory wearing a hard hat. On top of that, a $5 billion buyback and a dividend growing 10% a year. Stability and growth in the same stock. That combination is exactly what the market is paying up for. But let's pump the brakes because at this price, the risks matter. Constellation trades around 23 times forward earnings and closer to 37 times trailing. Those are multiples the market reserves for growth technology, not power plants. The entire valuation rests on one belief, that the AI power boom is durable and that these data center deals keep multiplying. If AI capital spending cools, or the market simply decides a utility shouldn't trade like NVIDIA, the re-rating down would be sharp. Two more risks worth tracking. 1. Execution. Restarting. 3 Mile Island by 2027 or 28 is a first-of-its-kind project, with regulatory and engineering risk baked in. Delays would dent the story. 2. The company is not a fully regulated utility. A big chunk of its power is sold into wholesale markets, so its earnings still swing with power and gas prices. Add the Calpine debt and a fresh stock offering to help fund growth, and you've got a balance sheet doing real work. The moat is durable. The valuation assumes nothing goes wrong. Put the numbers together. A roughly $104 billion company, trading near 23 times forward earnings, growing earnings north of 20% a year, backed by 20-year contracts with Microsoft and Meta. Bulls say that growth justifies the multiple. This is the rare utility with a genuine secular tailwind. Bears say you're paying a tech price for power plants, and the cycle always turns. At $100 billion, the easy re-rating has happened. From here, it has to deliver the growth it's promising. So, where do I land? In my view, the asset is extraordinary and nearly impossible to replicate. You cannot conjure 22 gigawatts of licensed nuclear out of thin air. The risk isn't the business, it's the price you pay for it. At 23 times forward earnings, a lot of good news is already in the stock. The contracts are real, the growth is real, but so is the expectation. Constellation isn't a cheap stock. It's a strategic asset the market has already noticed. My base case for the next 12 to 18 months. Most likely, the growth keeps coming as more data center deals land. But the stock moves with the AI narrative, not utility fundamentals. Watch 3 signals. First, new hyperscaler contracts. Each 20-year deal adds visible contracted cash flow. A drought in new deals would stall the story. Second, the 3 Mile Island restart timeline. On track for 2027, 28. Slippage is a warning. Third, earnings against that 20% growth target. Land inside $11 to $12 for 2026, and the trajectory holds. Upstream, Constellation depends on uranium supply and the regulators who license reactors. Downstream, it now powers the AI economy itself, the catalyst that lifts it, the next Microsoft-sized deal, the one that breaks it, AI spending cooling, and the multiple with it. Constellation turned the most out-of-favor energy in America into the most strategic, and the market repriced it from sleepy utility to AI infrastructure. The bull case is the irreplaceable fleet. The bear case is the price. At 23 times earnings, the market is betting AI's hunger for clean power only grows. So far, every data center deal says it's right. That was the third in our company deep dive series. One stock, all the numbers, no hype. I'm Big Z. Follow me. See you in the next deep dive.